Hello, and welcome to the September 2022 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner and your other advisor, Mark Zavitz. So today we're going to kick things off. We're going to spend about 10 minutes giving you a market update, and the next 10 minutes we're going to focus on a financial strategy this time, and we're going to explain to you how RESPs work and why, if you're considering ever gifting money to your kids or your grandkids, that RESPs make a great tool and resource for you. So, market update. Okay, what's happened since our last update about a month ago? Well, the big story was central banker Jerome Powell, who was head of the US Federal Reserve, speaking to the press about his plans for interest rate decisions in the US and taking what's known as a more aggressive tone, a hawkish tone, than the market had been hearing since July. So that's a very stark contrast to what we were hearing in July. This tone change being a stark contrast to his previous release really, shocked markets. In his previous release, he was talking about being data dependent, and then the market was reading that as what's known as to be a dovish tone. And a dovish tone means that maybe we're not going to be as aggressive with rate hikes. And change it to a more extreme hawkish tone certainly scared a lot of people. And when central bankers pivot like this in their messaging, especially one like Powell, whose direct impact and his words affect the world's entire global economy, because the US is representative of about 30 to 40% of the total global economy, markets actually hate that. So because when central bankers speak, market participants are always trying to anticipate the future forecast of what's going to happen with the information given. Markets want rates to remain low, and they want the stimulus tabs to stay on. However, what they mostly want above everything else is consistency and stability. And so far from Jerome Powell and his team and the Central Bank of the United States, unfortunately, we haven't seen that. At times where they've made calls that they're likely going to be increasing interest rates 25 or 50 basis points, such as earlier in the summer and the spring, they actually went ahead a week or two later when they make that actual call, increasing it 75 basis points to 1%. So it's not lending any credibility to the messaging that's coming out, and it's leading to market participants not necessarily trusting the Federal Reserve. And in Canada, we've, recently, so far in the past week or so, we've seen an interest rate hike of around 75 basis points or 0.75 to an overnight rate of 3.25%. It's largely been expected by the market, so no surprises there from our Canadian central bankers. It's mostly already priced into stock and bond investments, and there's a future expectation of 2 or more smaller rate hikes to continue before the end of the year. So what does this mean for you? Well, for your investments, specifically the ones that we help manage for you and your mutual funds and ETFs, it doesn't mean much. It's already priced in. It does mean something, though, if you do have some debt. So if you have debt such as a mortgage, if it's fixed, it doesn't mean anything. If your debt is variable, such as a demand loan, or you've got a variable rate mortgage, your payments in many cases have likely stayed the same, specifically when it comes to mortgages. But if you take a look under the hood at the amortization period, well, that's significantly changed for most individuals who have a variable rate mortgage. So someone who might have a 25-year variable rate mortgage that they got at 1.5% to 2% at the interest rate lows a 1.5 to 2 years ago. If they look under the hood at the amortization period, instead of seeing, say, 23 or 24 years left because they started that mortgage 2 years ago, their amortization period at their locked-in rate of variable rate of 1.5 to 2% has likely doubled or tripled now, because that same rate that's being offered for that same risk level by the bank, well, that's at 3.5 to 4% or 4.5%, and the amortization period that you're going to see on your mortgage might be 50, 60, 70 years, getting closer to what's known as a trigger rate, where in fact they do raise their payments. Again, in our previous updates, we were forecasting that rates were going to increase 75 basis points, and indeed that has happened in line with expectations. Mark, anything you want to add with respect to interest rates and the interest rate hikes we've seen in Canada?
Yeah, no, just, what you mentioned about the consistency coming from the Bank of Canada is very positive. And like you said, there were no surprises. The Bank of Canada has given us almost exactly what they told us is coming down the pipe. So, and of course, the Canadian market is very small on a global scale. So, what happens here doesn't cause any big ripple effects really anywhere.
Yeah.
But, just to speak to your comments in the US, yeah, we definitely need to see some stability and some consistency in the messaging from the Fed. It's very difficult for everybody to make future plans, and whether you're talking about investing money or running a business, when the forward thinking changes every 2 weeks, it just makes it very, very difficult. And like you said, people get scared because they don't know what the future holds, and when they get nervous and when there's uncertainty like that, it almost always triggers a sell-off in just about everything. So we're looking for some consistency from the Fed, and hopefully we're going to get it going forward. Bad news is not as bad as not knowing what the news is.
Yeah. I think we almost end up in a state of paralysis for all economic function when we're not sure as to what the news is going to be, and if we can't forecast, and that's really what is a driver for almost all business investment. And I think you hit the nail on the head, making a point talking about this uncertainty kind of grinding things down to a halt. So markets, equity markets specifically over the past month, they reacted sharply to this uncertainty and this 180 in tone change. If you look at the S&P TSX Composite, which is the Canadian stock market indices, it is down around 2%. But if you look at the peak to trough, that's a drop of around 5 to 6%. U.S. markets, specifically the S&P 500, the 500 largest quote unquote companies that are global, that from peak to trough went down around 7 to 8%, and the Dow Jones Industrial Average down roughly about the same from peak to trough. So a lot of the gains that we'd seen in the rebound from the lows of June into July, a lot of the gains that we saw around 10, 12, 13%, those have come back. Not fully. We're not fully at the lows that we've seen. We're still 3, 4, 5% ahead of those lows, but we did see quite a strong reversal, and a lot of it happened over the course of a 1.5 to 2 week period. So very volatile markets, very quick, sudden movements. And although these numbers say, as of September 8th, we're September 9th today. In the past 2 days, we've seen a very quick rebound. So the numbers are a little bit better than what we see right now. Over the past 2 days, these numbers are about 2 days old. And we'll obviously speak to that in our next monthly review, but just goes to show how quickly things can fluctuate and go, come up and come down. So bond markets is another thing we like to talk about. Since most of you are conservative investors, meaning that we have you invested in a model that consists of around 40 to 60% in bonds. Bonds are right back down to the lows that we've seen in July. And unfortunately, bonds as a whole are down around 10%, 10-ish percent year to date, sometimes 11 to 12%, depending on the type of bond that you're invested in. The overall bond market, though, when it's anticipating these future rate hikes and future rate expectations, again, it's forward looking. However, if we do start to see some certainty, I do expect some of these losses that we've seen in bonds to eventually course correct. And instead of it being down 11, 12% as a result of duration and interest rates, and as we know, and we've explained in the past, when interest rates go up, bond prices go down. Well, the inverse of that is likely going to come. And some of that capital loss is going to be replaced with capital gain. And the other good point being that the bonds, they're no longer going to be yielding 0.5% to 1%. We're also going to be able to make up some of these losses because our bonds are going to be yielding somewhere in the ballpark of 2 to 4% on average. So again, if you're a conservative, low risk investor, it's not been a good year for you. For any balanced type investor, specifically older investors, this is the first time we've seen this type of a correction in some time for fixed income investments. However, this looks to be the low. And unless we see some crazy inflation surprises coming out, and we're starting to see jobless claims, and we're starting to see some negative news. And negative news is actually good news because it means that the economy is slowing down. Then that means we've likely seen the worst of it. And over the next 2 to 3 years, I'm thinking that as long as these forecasts that I'm reading into, they play out the way I think they're going to play out, that we're going to regain some of those losses in fixed income and conservative portfolios that have unfortunately affected us. When it comes to commodities, again, case in point, the inflation story. Last time we reported on these commodity prices, crude oil was trading in the mid 90s. Natural gas was trading just above 8. Gold was trading around 1800. So, the inflation calculation takes into consideration the energy prices and the oil prices and natural gas. And that's come off another 3, 4, 5%. Don't pay attention to the change. This is the 1-day change that we were seeing. Overall, this part of the inflation calculation has come down nicely, and that certainly helps the not having to raise interest rates more than we need to story. When it comes to investment growth, the majority of you have been rebalanced into one of these portfolios. The growth, moderate growth, conservative, or very conservative portfolio. You can see if you had $10,000 invested over the past month in the very conservative portfolio, unfortunately, you're down to around 97 in terms of your investments. The growth portfolio dropped a little bit more, but overall as a whole, you can see that we were down, I can't really specifically say that on a percentage basis, but, down a little bit, but not down as much as the markets, which is the entire goal of being invested in a balanced portfolio. And as a reminder, the very conservative allocations, they've got around 25 to 30% in stocks, all the way to the growth style portfolios that we have some of our clients invested in that have closer to 75, 80% stocks. So the volatility measure of the growth portfolios, 2 to 3 times more risky than the very conservative portfolio. And if I were to guesstimate an expected return for the very conservative all the way to the growth, the very conservative portfolio should have an expected return going forward of around 3% after fees. The conservative portfolio is probably around 4% return after fees, a moderate portfolio around 5%, and a growth portfolio around 6% after fees. So we mentioned at the beginning or at the onset of this video that we wanted to talk to you about financial strategies. In our previous 2 updates, the first one we talked about ETF strategies. In the last one, we ended up talking to you about housing or giving our outlook on anyone who is considering either buying or selling housing and the local effects of being in this rising interest rate environment and the housing correction that we're seeing based off of regional incomes. This time we want to talk to you about RESP strategies. So seeing as how we're in September and it's back to school for many of us, or perhaps your grandkids are going back to school, we want to talk to you about RESPs as a strategy. And RESPs deserve a lot of respect. You guys have heard of the comedian Rodney Dangerfield. He's passed away. He used to say he ain't getting no respect, but I would say RESPs deserve a lot of respect, and they can be used as a tool for shifting income, saving money, and also passing along inheritances down to your kids in a tax efficient manner. Not to mention, obviously, saving for a child's education, because we all know that education costs have gone up substantially over the past couple of years. I was surprised to see exactly how expensive tuition costs are now in Canada. I graduated in 07, 08. And I remember my tuition costs for business, the average tuition cost was around $4,500 a year. Well, that same cost on average in Canada for a university or college has gone up to almost 7 grand. That's almost like we're getting 50, 60, 70% higher from when I graduated 15 years ago. Now, if you've got some really smart kids or grandkids and they're looking to get into medicine or they're looking to become a dentist, these tuition costs are absolutely insane. For dentistry, we're looking at 22 grand. So the amount of money that needs to go into saving for a child's education is quite substantial, considering most programs are 4 years, and this is on a per year basis. This doesn't even include housing. This doesn't include anything, transportation, any of these other costs. When you factor that in for school, you're looking at, 40, 50 grand a year in Canada for going to dentistry school here. Like, that's insane. Kids are going to need up to 200 grand if they want to become a doctor or a dentist. Like, it's so much money. So if you are thinking of helping your kids or your grandkids out and exploring the use of an RESP account, I think first we want to cover the basics of that. And then second, we're going to go through a strategy that we can potentially help you implement if you want to pass along money to help your kids, especially those that are smart and or your grandkids, and potentially save more money after tax than you would in a traditional way. So the basics of an RESP are that they are a tax sheltered account, kind of like a TFSA, that allow individuals or beneficiaries to save money to go to college or to be used for university or a trades or an apprenticeship. It can hold, and it should hold, investments. There are different types of companies actually that are not just investment companies that offer RESPs. Some of them only hold cash investments, which I don't think are a good type of investment because cash investments don't generate enough return. So I would stay clear of those types of companies. Obviously, if you're tuning into this call, we offer RESPs as an account type for you, as a means to be able to help your kids or grandkids save for education purposes. They're an account type that attracts free money from the government. And this is one of the main attractions to using an RESP, aside from the fact that they're a tax sheltered account type like a TFSA. Money that you put into an RESP attracts what's known as Canada Education Savings Grants for the beneficiary if they're below the age of 18 years old. And the amount that you can save is typically around, or receive from the government, should I say, is typically around 20 cents for every single dollar that you put in. Now that's capped, but this is free money that if you're intending to go to your kids or grandkids and it's currently sitting with you, just invested, not doing anything. It's earning its 4 or 5 or 6% return depending on the portfolio that you're in. Well, there's a whole basket of free money that your kid or grandkid might be entitled to if instead we shift this money out of your hands into still your hands, but into an RESP account that will eventually go to your kid or grandkid anyway. And if you also happen to be, or your family happens to have a low income, then just opening up an RESP account entitles you in some cases to what's known as the Canada Learning Bond. And that's a free $1,000 bond that the government will just inject into your account for simply opening it. The income thresholds for that are quite low. It's designed to promote savings for low income families. But let's just say, you're a grandparent and your kids have, their own kids. So you actually have grandkids and they happen to be of low income and you're supporting them in some way. Well, don't shy away from potentially just opening up the RESP account, because if their family income is, say, below a $45,000 threshold, just opening up this account might entitle them to a free $1,000 of Canada Learning Bond per year while their income remains low. So something certainly to consider. I was mentioning before that there is free money that most that everyone's entitled to if they're below the age of 18. The amount that any child can receive is a max of $500 per year, or it's typically $500 per year. If your income's low, it's $600 per year. And to get that $500 per year, you need to contribute $2,500 per year for that child. So because it's on a 20 cents to the dollar basis, you do the math, 20 cents per dollars on $2,500, it's $500 in free grant money. And that maxes out after, we'll call it around 14 years of having contributed $2,500 per year at a max of $7,200 in free grant money that the government's going to inject and deposit into the RESP account, matching the $2,500 that you're putting in for the lifetime. There are, you can add more money in them. And this is where I think there's a lot of confusion when it comes to RESPs, and where it makes sense for a lot of individuals, especially if they're going to be covering, $100,000 or $150,000 of educational expenses. We're shifting more than just the $2,500 into the RESP account makes sense. And that's because every beneficiary, every kid who's named in the RESP has a maximum lifetime contribution limit of $50,000. So $50,000, can go into the RESP technically in one shot. That means you can't put anything else into the RESP. What most people tend to do is they don't know that there's a $50,000 threshold, and they end up, or what they do is they end up putting in $2,500 per year just so that they can maximize the grant money that they're going to get, and that's all they do. When there could be something else that we could do instead, and that might mean injecting say $20,000 to $25,000 or $16,000, something like that, early at the onset of creating the RESP. And the reason for that is because the RESP is tax sheltered. But I'll take us through that real quickly. So hypothetical scenario here. Let's just say you're a parent or you're a grandparent and you've got $50,000 today in today's dollars that you've got earmarked for your kid or for your grandkid. Let's assume that you're in a 25 to 30% tax bracket, which is, I would say, Mark, would you say 25 to 30% tax bracket is roughly where we see most of our clients who have kids or grandkids from a marginal tax bracket standpoint?
No, actually, I would think it's actually higher. I think, we're catering to the most part here to, well, I just look at my own situation. I finally have a grandson, and I started, he's 8 months old, and I started a registered educational savings plan for him about when he was 3 or 4 months old, so about 4 or 5 months ago. So most grandparents that, and again, this doesn't have to be grandparents, but if we're talking about grandparents, most grandparents that would have 50,000 set aside to gift now are probably in I'm going to say a 30 to 40% tax bracket, marginal tax bracket, which is just going to make the point that you're going to make here stronger, because it's allowing me, that's my tax bracket, and it's allowing me to take some money and move it over and get it into a tax sheltered educational trust, and rather than sit in my name and get taxed at 40% for the next 20 years.
Exactly. Case in point, the traditional way, and thanks, Mark. The traditional way of putting money aside for kids is just to maximize the grant eligibility and to receive the $500 per year. And that's the way most advisors recommend, or have recommended in the past. People, when they open up RESPs for their kids or grandkids, begin funding the account. So you put $2,500 in per year, you take a look at some of the non-registered assets you've got, or some of the cash you got sitting around your bank account. Like most people have a little bit of a buffer. And then when we review and talk about, financial planning with you, we put aside, or we inject $2,500 every year just to make sure we get that free $500. Now, the problem with that is if you've got, say, like a lump sum, that lump sum, $50,000, stays in your hands. And because you're in this 30 to 40% tax bracket, as a result of that, you're going to have tax drag on the growth of that money over the years. And unfortunately, because you've got a higher tax bracket, that means that after tax, you're still going to be okay because you're getting grant money. But after tax, there might be a better solution for us to begin tax sheltering some of that $50,000 now, although it won't receive grant because we're going to be injecting more than we need to in the account. Shifting it into that RESP is a tax sheltered vehicle. And if we can shelter that growth for 15, 16, 17 years, on a net basis, what's going to end up arriving in your kids' hands is going to be substantially more than if we just keep that $50,000 in your hands today. Case in point, and to Mark's point, if we at a 30% tax bracket decide that we want to instead inject a large lump sum year one instead of the traditional $2,500 a year of $16,500, and then we follow that up with $2,500 a year for the next 17 years, we still capitalize on receiving full grant money from the government. We're still getting the free $500, but instead of having $16,500 sitting in, grandma or grandpa's investment account or checking account, earning 4 or 5% and being fully taxed at 30 to 40% level, as Mark was saying, instead it's tax sheltered. And the findings that we've come up with after running this exercise is that, we end up with, on a gross basis, roughly the same amount of money. If you look at this slide, the total gross value after 17 years, not including any tax at all, is basically the exact same. You're going to end up with, if you've got 5% growth, a total amount before tax of $126,000. However, if you inject early on $16,500 and decide to follow that up with a $2,500 contribution and receive the free $500 from the government, after 17 years, because we've tax sheltered a big portion of that $50,000 at the onset, you're going to end up on an after-tax basis with $10,000 to $15,000 more than had you taken the more traditional route of just putting in $2,500 per year. Now, you might be thinking to yourself, obviously this is great, but I'm worried about, giving my kids this money at the onset. Like, what if I need this money and I don't want to put in a lump sum? And, what if I need this $16,500? Well, contrary to what people traditionally know about an RESP, the money that gets put into an RESP, the original capital, actually belongs to the subscriber. It belongs to the parent or grandparent until it gets drawn out. And when it gets drawn out, if it's original principal that gets drawn out, the original money that goes in, the grandparent or grandparent actually still owns that money. It's actually still, you still own the money in the RESP. So if you're worried about employing this strategy because you think it's going to be too much money going into the hands of the beneficiary, which is the kid or grandkid at the onset, well, just know that you actually still own this money and you can take this money out without there being any tax consequences. There's going to be some tax and there's going to be some grant that goes back to the government. You're going to lose 20% of the growth. But that being said, any of the money that goes into an RESP belongs to the parent or the grandparent and will always belong to the parent or grandparent unless there's a declaration that's made when we do a withdrawal for education purposes when the kid goes to school, in which case the money can be withdrawn and taxed in the hands of the child or the grandchild, which is what most normal RESP withdrawals are, and at which point we shifted the income. But there's no real risk to employing this strategy if you're the parent or the grandparent and putting a larger lump sum into the RESP today because you have access to this money. So if you've got an RESP account and you've got other accounts with money in them, and say you've got a non-registered investment account, and this type of strategy you think is one that you want to employ, please feel free to reach out to either Mark or I to discuss this strategy to see if it's appropriate for you. And we're very happy to discuss your individual situation for you, because quite frankly, I think it's one that many people who have an RESP open for their child or grandchild should be employing, because there's very little or almost no risk. And with the cost of education and tuition where it's at, and where it's likely going to continue to increase at for the foreseeable future, being able to save an extra 10 or 15 or $20,000 by taking a more tax efficient approach is one that we should be doing almost exclusively for everybody. So with that, that wraps things up. I'd like to thank everyone who's decided to tune in. If you've been with us for this long, really appreciate you taking the time to hear us out. And if you have any questions with respect to our ESPs or any of your investment performance, please feel free to reach out to the team or Mark and I. We're very happy to have a conversation with you. Mark, anything you want to add?
No, just that thinking back, I went to university in 1979, 1980, and tuition, Greg, was for a Bachelor of Commerce degree, tuition was $1,000. And the all-in cost to go away to school with rent and food and everything was about $5,000 to $6,000 per year. So, you know, the costs now are incredibly high, and this is certainly something that parents and grandparents are concentrating on for their kids and grandkids. But it's we need more people to use this tool, because, like you said, it's $150,000, $200,000 to get a 4-year degree now.
It's insane. And that's if you stay in Canada.
Yeah.
You got a kid who's an athlete and he goes to a D1, D2 school in the United States. They might get some sort of, bursary, or they might get some sort of, subsidy by going down there. But those costs are triple what you pay in Canada. Like, it's insane. So any dollar we can help you save by saving on tax is one that we think is worth it in most cases, and we want to help you with. Okay,
That's great.
Thanks so much, everyone. Appreciate your time, and we look forward to you to our next chat with you and to our next update. Cheers.
Bye, everyone.